Hello and welcome to session 1 of the real estate pro forma analysis. Just as a summary, a pro forma is really a financial model that is used by real estate professionals to project the future financial performance of a real estate investment. It's an Excel tool that's used by investors, developers, and lenders, as well as brokers, to determine the profitability of a project, whether that's multifamily, condo, office, and helps ensure that a developer is proceeding with a project based on its feasibility. So we're going to dive into an introduction here on the basic steps that go into a pro forma. This guide is going to provide a detailed walkthrough of the real estate pro forma. There's going to be 6 lessons. We're going to review how to analyze site information, to build our model. We're going to see what goes into the model and how then we can use that pro forma model to determine our returns and if a project is worth pursuing. Along with that model, we're going to determine how we figure out budgets, our financing, our sources of funds, and take some examples of certain projects that we've worked on to see how they apply in real life. What I want you to walk away from this course is with a real understanding of how the model is built. Being able to do this analysis on your own, either for your own development or to be able to work with a larger investment or real estate developer to work on their larger projects. You're going to see what goes into the underwriting, the steps needed to develop the pro forma, the assumptions that are made that go into that pro forma, usually based on market data and information you've gathered from other professionals. And then you're going to see the outputs of those pro forma. And by the end, you should be able to put together your own pro forma and deal sheet that you can either present to investors, take to your internal committee for approval of a project, or use to go find a co-developer or sell a property based on your findings. So first, let's understand what is underwriting. Underwriting is a financial analysis that developers use to calculate income and expenses, which is then in turn used to calculate the building's return and property value. A pro forma is the model that takes that information together and spits out the information. Along with understanding underwriting, you have to understand what your risks are. Now, these risks are shown in the financial model through a sensitivity analysis, through contingencies, and through the different inputs that you enter into the financial model, whether they're conservative or aggressive. Timing also plays a part in any real estate investment. As we know, the market is cyclical, which means that there'll be times where you're projecting a higher growth, and there's times when you're projecting a much lower growth, depending on where the market is in its cycle. There's 7 major steps to building the pro forma. First, as I mentioned, it's gathering the information. It's understanding from the local markets what the comparable sales are, what rents are, information about your property, the zoning, location, what you can build, or if it's an existing building, existing rent roll, and how that's going to be then used in your model. After you gather that information and enter it into your assumptions page, you're then going to project your revenue. That's going to be based, again, on market data, occupancy rates, vacancy rates, and you're going to project that out a certain amount of years that you intend to hold the property. On the flip side, you're going to calculate your operating cost or your expenses. You're using data from the property. If it's an existing property, your taxes, your insurance, costs to maintain the property, management fees to run the property, or you're making assumptions based on properties nearby or typical percentages to determine what your operating costs will be. In this cash flow model, you're also going to project your future growth, where those income and expenses will either grow or shrink depending on where the data is telling you. A lot of that information you can find from large companies that produce an inflation data analysis and can tell you if rents are rising, if rents are slowing down, if you see expenses going up, and then you can enter that growth into your cash flow to determine how your future years are going to perform on this property. Then you're going to estimate your renovation costs. We're mostly going to focus on ground up properties. But you may also have, if you're building an existing building, capital expenditure costs, renovations, improvements. If you're obtaining an existing property, you may be looking to make improvements and add value to the property right away. For a ground up, new construction project, you obviously are taking a vacant piece of land or knocking down a piece of land, and you're going to calculate what your full construction and development cost is going to be. And then from those inputs, that's where you're going to determine the valuation of your property and your returns. Your annual returns as you run the property, and then your exit return as you either sell or refinance the property, depending on what you plan to do with that asset. We'll look at how to calculate IRR and your return on investment, as well as a couple other metrics that investors use to value what their profit will be and if this is a good investment. I already mentioned site information is the first step in entering into your Forma. So your site information is your key information about your property. Where your property is, your square footage, the gross square footage that you're allowed to build, depending on the zoning analysis. Also, what zone it's in, whether it's a commercial, residential, what is the best use for this property if you're building ground up. You have to understand first what the zone allows. Your density and height restrictions, this all goes into what you can build, will affect your construction costs, as well as will affect the floor area or the gross floor area that you can then market, sell, or rent out. And any specific requirements to the property. Are there setbacks required, parking requirements? Are there inclusionary housing requirements? Are there open spaces that are required in this zoning? Those factors will obviously affect your building square footage and what you can do with the space. You have to take all those into consideration when determining what our total square footage will be. Revenue projections is based on your unit mix. You're going to determine how many units you plan to have in the building or how many units they already are in the building. And that unit mix is going to be a mix between 1 bedrooms, 2 bedrooms, studios, 3 bedrooms. You're going to determine how many bedroom baths, what the projected rent is. In existing buildings, you might use an existing rent roll that you have. Maybe you're buying it from an existing operator. You should be able to get that rent roll information during the due diligence period and then project your rent, or if you're building a condo building, your sales based on the market data. You always want to factor in a vacancy rate. of, especially in rental properties, if the property will sit vacant, and then your lease up and growth time. If you're building a ground up building, you want to make sure you account in your timeline how long it actually take you to lease up the building and get fully stabilized. Your operating expenses, or your carrying costs, are part of your expenses. Your utilities may include electricity, water, and gas. You're going to have property taxes and insurance. These are going to be either if you're taking an operating building or if you're building a ground up property. Those utilities you're going to use during construction, and property taxes, although lower during a vacant property and during construction, you will still have some property taxes and insurance to cover for your work. Repairs and maintenance you will see in further out years when you have an operating expense. This could be capital expenditures that you have to put aside, such as a roof replacement, equipment replacement, improvements on your common areas, and then general maintenance. Equipment goes down and you need to repair it. And then management and marketing. Especially if you're doing a new ground up building, you want to make sure you account for any marketing or sales costs that you may have, plus your property management and actually running the building. Now, your net operating income is a calculation that is based on your income minus your expenses. It's used throughout the industry to determine the property's profitability. And this is all before you have any debt services accounted for. This is assuming a clear and free property without any mortgage encumbrance on it. This is calculated annually or monthly, depending on how you want to run your cash flow. And it really reveals later on your value of the property. It's crucial in the value when you're using the capitalization rate method. Your NOI is based on your NOI with your cap rate is going to determine what your building is worth. So as we see, with your expenses and your income, it's important to make those assumptions using as much market data as you can to be as accurate as possible. Your acquisition and development cost is going to be the purchase of your property, any fees, taxes, title insurance that you would have to pay during your acquisition. So it's any closing costs that you have. And then your development costs are your costs that you're going to take to design and construct and turn over that operating building. So initially you're going to have soft costs, which are your architect and engineer, A&E costs. You're going to have hard costs, which are your construction costs and what it takes to build the building. And then you should account for any contingencies for unforeseen events during construction or during soft costs and design, and have that as a buffer to make sure that you don't run out of a budget before the project even gets going. Your total development costs are not only going to include those, but also your land acquisition, construction, your permitting, and other fees. Your total development cost is determined by you and professionals that you reach out to gather these estimates. They are also a key factor when you're looking for financing from lenders. They are going to vet and look through your backup of how you made assumptions and confirm that based on market and industry standards in your area, that your numbers make sense that you've assumed. One other thing we're going to touch on during this training is the sources of funds. There are a few different ways to actually fund your project. First one obviously being equity, where you have investors, or you as the developer or the sponsor are coming in and purchasing the property. and funding the construction and renovation. You can also have general partners that you partner with, or limited liability partners, or limited partners. Partners are usually going to request a certain return, so it's something that we're going to, in this course, we're going to review and study how different equity partners affect our capital structure and how they come into play in this. Your debt financing is very similar to your home mortgage. You may have different levels of debt financing in a larger deal, from a senior loan to a mezzanine loan, but it's very similar where you have an interest rate, you have closing or origination costs, and you have certain metrics or return of that debt that you have to provide at the end of its term. Along with that, we're going to look how the debt really affects our valuation. We're going to look at the loan to value and the loan to cost ratios. Lenders will look at this when they're evaluating your property to determine if they will actually fund it, how much equity they may require you to put in the deal or your investors to put in the deal, and how much are they willing to lend. We're also going to go into the project timeline. Obviously, your longer your project, the more you're going to spread out your returns. So you're going to estimate the total project duration, all phases, from land acquisition to design, entitlement, permitting, through construction, and lease up. You want to at least have a basic understanding of what those timelines are. You want to develop a schedule that shows that timeline. And then that's going to determine when you need to secure financing for your project. You may fund the initial part of your project with equity that you have or your development team has, and then look to get construction financing in the future when the design and everything is settled and you have permits in hand ready to go with a contractor. And then also you want to determine when your permanent financing will take in place, which will likely be after you're fully leased up, you have leasing agreements in place, and it's a stabilized operating asset. You also want, the timing will also depend on what your property valuation is, including that refinancing into a permanent loan. You may not want to go for a permanent loan with a building that's half occupied if your income isn't showing its full potential against its operating expenses. So we will put together a timeline of when each of those items actually occur. We'll also go into the different property valuation methods that there are. In this case, multifamily, we will mostly focus on the capitalization approach, or your cap rate. There's also, as you've seen, a sales comparison approach. This is used a lot. We'll use this when we're even analyzing condo sales. We'll see what similar properties have sold in the area in recent months, 6 months to the past year. This will help determine what the property value is. This is not as common with multifamily and larger projects just because they all vary in size and really vary in the product that's being offered and how they're run. But we can use this for individual condo sales that we are providing. The cap rate approach is really what I mentioned, based on the net operating income divided by the cap rate. That'll tell us a good expected return or valuation of the property, and then help us determine what our return metrics are. Or the last is the cost approach, which is far less popular, but it is based on a replacement value of the property. So this will estimate what a land cost would be based on what comparables are, and then also what it would be to actually replace the asset that you have. This is used in newer projects just because we know what the cost to build it is, but it's not really used in later years to determine the valuation. It's mostly used to give you an appraisal or value of your property as you're building it. If something catastrophic were to happen, you would know its appraised value based on the amount that you've put in for land acquisition plus what you've spent actually on construction costs to build this property. So there are a few different return metrics that we will review and dive into, and we'll see in the Proforma calculating these. The first will be cash on cash return, which basically measures your annual return on your initial investment. It's going to tell you exactly what your percentage return on what you invested. The internal rate of return, or your IRR, is going to show your annualized return. So this is taking into account how much time you actually get your return back. Your cash on cash return is really looking at two standard points in time: your initial investment and then your return at the end, at your exit. Internal rate of return considers how long it takes you to get that return back. Your equity multiple is used by most developers just to tell you what your return is based on what you invested, what was the multiple of what you invested versus what you're getting. And then we're going to look at levered and unlevered returns. Most deals are reviewed as an unlevered return basis first, and then you factor in your debt financing afterwards to determine how your debt really affects your ability to build this project. And that is also based on timing, because as we are now in a high interest rate environment, your levered return really is far different than your unlevered return. With a lower cost of interest, you're going to find those numbers very similar and actually benefit you to go with debt on your property, because you aren't paying much for that debt, and you can put in far less equity into the deal because you're funding it mostly with debt. You're going to find when you have debt in a high interest rate environment that the numbers really start to shift, where not all deals will make sense paying such a high amount for that debt, because you're really taking away from your net income, your cash flows, and ultimately your valuation of the property. In summary, the Proforma that we're going to learn in this course is a critical tool. It helps all developers, investors determine if they should or should not proceed with a property acquisition, a land acquisition, and if they should develop that property or keep a property as an operating asset. It's used by investment committees. I've been presented with a couple of these opportunities that developers will come and pitch their property, show their returns, and they're using a Proforma to really pull out the data that they've analyzed and put it into a deck that's presented to investors. We're going to see that the data in the Proforma really comes from various sources. We're going to go over how you can look at public records to see it, how you can look at market data that you can look up online, and how some of this data is actually coming from your internal experience or other professionals in the industry. And as stated earlier, a Proforma is an industry standard. It's used by brokers, investors, developers, property managers. They all share this one tool to help them understand how an asset is performing. Even though they all have similar inputs and outputs, they may vary. You will find that there may be a dozen to 20 different investors looking at the same property and question why one would proceed with this investment rather than the other 20. That's because they're all putting in different data. They're making various assumptions of what they could either build the project for, what the sales would be, or the rental income would be afterwards. They may even look at a piece of property and determine that the use of that property is completely different than what is being pitched by the brokers or what the current zoning even is. And we'll study that as well in this class, how you can go and change the zoning use for a piece of property to a better use. All in all, the Proforma is used to develop a successful real estate project. This guide is going to help empower you to make those decisions on either your own investments or to be able to pitch to investors for a development that you're looking at. So I hope you enjoy this course, and we're going to dive more into it after this.